Welcome, welcome. Welcome to another episode of Unlocking Your Legacy. I'm your host, Keith Robertson, the Fin Coach. Come on in the room, y'all. Gonna give you some more. I see you, Charles. Thank you for tuning in. I see you, Linda. Thank you for coming in, Ashley. Javion. I see you, Tanisha. Thank you for tuning in. Come on in the room, y'all. We got some pretty good information I got for you today, y'all. Come on in. All right, all right. First of all, let me thank you guys for tuning in once again to another episode of Unlocking Your Legacy. As I stated, my name is Keith Robertson, the Fin Coach. I am your host. This is where we bring financial literacy information forward because the goal is to get an understanding of how money works, how the wealthy have been utilizing various financial tools for decades to move generational wealth, right? Able to move that legacy from generation to generation while yet we sit back and watch what's happening. But now time is over because once you know better, you can do better. You know, it's sad that most of the time in the black community, the legacy we leave is of debt and problems. So we're here to make sure that you have information to position yourself and your family so you won't have to deal with that. So guys, what's happening now? What's happening? So what's going on out there in the economy? Well, we know the big news is of course everyone's still talking about, the Fed, Jerome Powell, what's gonna happen. Well, we just a couple weeks away from the next meeting, the Fed meeting, a couple weeks away, and we're gonna find out if he's really gonna decrease the rate. But now the question is it going to be 25 basis points or 50 basis points? As I thought about it, and again, this is just this is information for educational purposes only, not telling you how to invest. We don't tell you how to invest, right? You need to sit down with an investment advisor and get a clear, concise plan for your personal life. But anyway, it looks like possibly it may be 25.25%, 25 basis points a quarter. I really, I'm thinking that because, it's a rule of thought, right? You don't shock the market, right? Just like if you were selling a house, this is why they use appraisals, right? Because you can't put your house on the market for three times the value of the houses that are in the market, right? They're not going to allow you to set price like that. Or if you're going to buy a home, they want to allow you to do but so much more than what you're paying in rent, right? Payment shock. And it's the same thing that I'm sure that the Federal Reserve is contemplating where it comes to lowering this rate. But the JOLT report came out just yesterday, and that's the Jobs Opening Labor and Turnover Survey, where they talk about the jobs that are being listed now, and there are less jobs. Actually, the jobs report is now less than what they were prior to COVID. So what is that telling us? It's less jobs out there, y'all. Period. It's less jobs. Of course, you're gonna always see like the service jobs. The service jobs are gonna be there, but when we look at what's really going on in the economy, there are less jobs. People are getting laid off because we talked about that last week. Layoffs are higher than what they had reported, but now we see that there are less jobs. So individuals are putting their resumes out and not getting the responses in which they once were. And this is the reason why there are less jobs. So what do? We have to combat that, y'all. We have to one look at what we say our first business is our family business, right? We need to look more into the money that's being left on the table per the title of today. The first thing that we need to do, okay, the monthly expenditures. What is the income? Well, let's go with the income. What is the income coming into the house? Do you really know the income that's coming into your house? Have you been on a job for an extended period of time, 10, 15 years or more, and at the point in time when you got into that position, did you, or I should say, did you go back and look at your W-9 since that point in time when you started the job? Because a lot of times, a lot of things have happened since the point in time when you've gotten into that position or hired for that job, where if you make adjustments on your W-9, you could bring more money home. If you're getting this big, huge refund check every year, letting the government hold your money for you. There are other things that you could possibly be doing with that capital, I'm sure, other than letting the government hold the money. Because typically what happens, you know, um, people that get large refunds on an annual basis, they will wait for that refund to pay debts off, to buy depreciating assets and things of that nature. So it's about having a comprehensive plan. Now, that comprehensive plan may be based around, your household financial planning. When you look at the money that's coming in and focused on the money that's going out, remember I told you guys about that last week. But when you leave money on the table, what does that mean to you? Well, that means that you don't have additional money to pay down debt. You don't have additional money to put towards savings. You don't have additional money to put towards a plan of action. It's all about a plan, y'all. You wake up in the morning, you have a plan. I'm sure you have a plan, especially if you have kids, right? You wake up, you got to get them dressed, get them out to school. You just don't wake up and see what happens. You don't just wake up and not get yourself prepared for work. You know, it's all about preparation. And that's the same thing about your financial house. You have to prepare for the future in your financial house. When we look at it, are there the little things? Netflix. Well, Netflix is killing me. Netflix when I first got it, I think it was probably under $5, and now I'm paying 19. But it kind of creeped up, right? And then of course, if you subscribe to certain things, and just a few dollars, $1.99 here, $3.99 there, you know, over the time of a couple years, go back and take a look at those automatic payments that are coming out of your bank account. Go back and take a look at that. Now, is this something that you really are using, or did you forget about it? Because when I went back, I should say, and I took a look at my expenditures, there were some things that I didn't even realize I was still paying for. $5, $10 here, it means a lot over the course of a year, or multiple years. Again, these are funds that could be put in other areas. That's right, T. Facts. Because we get in the mode of surviving, right? Well, it's a day-to-day grind, and we never really look at the details. When we go out and we look and see if we're overspending in certain areas. If you have a plan to buy something, why don't you do online shopping first before you just go out and buy? Or even if you're buying online, look and see what is the best value at the best price. These are the small things that we can do. I mean, it's nothing big, but we have to put intent on our actions. We have to pay attention to what it is that we're doing out here in our financial lives. So, one of the things that I was asked again about the infinite banking, when I put a reel out there about being your own bank, and someone asked me to really explain what it is that I'm talking about. And let me see if I can do this real briefly here. So when we look at becoming your own bank. That's a new buzzword that they're using out there, infinite banking. But y'all, listen, this has been around for decades. The wealthy have been utilizing various financial tools, insurance policies, to actually finance their lives. You know, I talked to a young man in the Jewish community. He was paying cash for a home. And the question was, how did you do that? I said, well, when I was born, my father took out a insurance policy on me, and they were funding that account so that it increased in the cash value. They were able to overfund the account and put as much as they could in that account. And at the point in time that this guy, I believe he was about 23, he had money to pay cash for a home. That's right, because of the plan. See, we have these things in place. I've told you guys about the $1 million baby policy. If a child is 15 years old, they can have an insurance policy placed upon them. And see, look, we have to get out of this mindset that insurance is about death benefits only. See, that's that old thinking. When we weren't knowledgeable about how to use these tools. So you have a child that's 15 days old, you begin to pay into a policy. When they reach a certain age, they have money to start life. See, this is how others operate. Now, as far as line as the infinite banking, okay. So something as simple as buying a car. What do you do when you want to buy a car? You may go to Navy Fed, Wells Fargo, Bank of America, Capital One, or whoever, and you go apply for a car, right? They're gonna want to know what is your income, what is your credit score. They say, okay, well you qualify based on that information. Then you go and you find the car that you want to purchase, right? They give you a dollar amount. You go purchase that car, then they will give you terms. Typically I've seen as far as 6 years. I believe I saw 7 years that they allow you to stretch it out that far now. And so you have a monthly payment where you pay your principal and interest to the lender. Right? And at the point in time when you finish paying for it, then they'll give you the title to the car. If it's a purchase. If it's a lease, then it's another thing, right? You just give the car back. But when you operate as your own bank, you've done like the Jewish scenario, like I just said, where you funded a whole life insurance policy, preferably one that will pay you dividends and that will have an accelerated cash value piece to it. So most of, or a large portion of your your monthly payment, your premium payment, a great portion of it will go towards the cash value. So what does it allow you to do? So when you have a scenario like you're gonna purchase a car, right? Let's say you have this policy, like I said, and you have 50,000 in it. Let's say 50,000. So the car is 25,000. Okay. So what you do is you contact your insurance company and say, hey, I want to pull out 25,000 from my cash value. The car's 25,000. I'm going to pull out 25,000 in cash value from my insurance policy. They're going to say, fine. A couple days, you have a check. No pre-qualification. You don't have to worry about your credit. You don't have to worry about your income. You don't have to worry about any of that. You get the money. But here's the thing. Remember I said you had 50,000 in cash value. When you received the 25,000 from the insurance company, that didn't come from your 50,000, because if you look back at your insurance report or online to see what your balance is of your cash value after you get the 25,000 in hand, it's still going to say 50,000. Because when you borrow from your cash value of your insurance policy, it comes from the insurance companies, their general fund, where all that money is. So you don't lose the momentum of your compounding interest. So your 50,000 is still working. It's still working, but you have the 25,000 from the general fund, while that 50,000 is still working. Now, the benefit of this is that now you take this to the dealership and purchase your car. You get your title right then because you paid cash for it. It's not being reported on your credit report. So if you're looking to do some other type of financial transaction, that car payment is not counted against you as far as your debt to income ratio. Now, what you do is you have to pay that back to yourself. You have to pay it back. You don't have to pay it back, but I call that eating your seed. You know, we need to stop eating apples, right? We need to plant the seeds from the apple, and then we go and pick the apple from the tree, if that makes sense to you guys out there. But anyway, so when you actually are when you have that 25,000, like I said, you have the 50,000. It's still compounding, still compounding, still compounding. Now you have to pay yourself back, but if you don't pay it back, again, this is insurance policy, and the way that an insurance policy works is this: if you were to borrow from that cash value and you didn't pay it back, it would come off of your face value of your insurance policy if you were to come to some unfortunate demise while you still had that loan. And you say, how does that work? I'm going to tell you how it works. Plain and simple. When you have cash value in an insurance policy, the face value is going to always be more. Your face value will always be more. At any time that the cash value is the same as the face value, it no longer is an insurance policy. It becomes what's called a modified endowment contract. And when that happens, then it's a whole different set of rules. So listen, so you pay yourself back. You pay yourself back, you pay yourself back principal and interest, but you're putting it back in with that 50. And it continues to increase in value. And that is being your own bank, y'all. What would you rather do? Would you rather pay Navy Fed, Wells Fargo, Bank of America, that principal and interest when you can pay yourself? It only makes sense. You know, and the way that it's done is through, again, a whole life insurance policy. A whole life insurance policy with a high yielding cash value that pays dividends. A mutual whole life insurance company, whole life policy that pays dividends with a cash value accelerator. I've heard online where they talk about an IUL can be used also. Okay, well, IUL, in my opinion now, this is just my opinion, an IUL, Index Universal Life Insurance Policy, which is based upon an index, is a long game. You know, that's the long game where you're able to put funds over there and you know, several years down the road where you have that cash accumulation, because it's a slower increase in that cash value. Matter of fact, most IULs have either a 5 or 10 year surrender clause, where it's an extensive fee if you surrender those policies within that time period. And within the whole life policy that I mentioned from a mutual insurance company that pays dividends, you don't have that. So I mean, these are the things in what we have to look at, because again, it's about leaving a legacy for our children's children. Right? Stop leaving problems and leave options for your family. Well, anyway, guys, that was a quick one tonight. Again, that's infinite banking at its finest. But I thank you for tuning in. And listen, if you guys would like to have a confidential, free, professional financial analysis done, right? Where we sit down and look at your situation and see how we can best help you, give me a call. 757 335 6772. 757 335 6772. But anyway, guys, my name is Keith Robertson. I'm your personal fin coach. I thank you for tuning in. Hope to see you next week. Peace and blessings.